So, you're thinking about buying a home, but the whole process just feels overwhelming, right? Well, you've landed in the perfect spot. In the next few minutes, we are going to break down the entire journey, step by step. Think of this as your personal masterclass on home buying, packed with expertise from the team at Got Mortgages to give you the clarity you need. Here's a quick look at our game plan. We're going to start with why waiting might not be your best move. Then we'll get into the nitty-gritty of qualifying, what those 4Cs are all about. We'll decode your credit score, break down your loan and payment, and, this is a big one, talk strategy for winning in today's market. All right, let's get into it. First things first, this is probably the biggest question on everyone's mind. Should I buy now or should I wait? Let's see what waiting could actually cost you. Check this out. Based on market data, waiting just one single year could mean you miss out on about $40,000 in home equity. And let's be real, that's not just a number on a screen. That's real wealth you didn't get the chance to build for your future. Now, if we pull back and look at the bigger picture, it gets even more dramatic. Over a 9-year stretch, that appreciation could be over $240,000. See, owning a home isn't just about having a roof over your head. It's one of the most powerful ways for regular people to build serious wealth over time. Okay, you hear all this stuff in the news, right? The Fed is raising rates. The Fed is cutting rates. Here's the thing you really got to understand. The federal funds rate is not your mortgage rate. One affects the other, sure, but your mortgage rate is mostly driven by market forces, like what investors are willing to pay. They aren't the same thing. So, you're feeling motivated to make a move. Awesome. But how does a lender actually decide if you're good to go? Well, it pretty much all comes down to what we in the biz call the 4Cs. These 4 things, they're like the 4 legs of the table. Every single lender is going to look at your capacity to repay the loan, the capital you're bringing to the table, your credit history, and the collateral, which is just a fancy word for the property you want to buy. So let's quickly unpack that. Capacity, that's all about your debt-to-income ratio. Simple. Capital, that's your skin in the game, your down payment. Where is it from? Savings, a gift. Credit is your financial report card. Plain and simple. And collateral is about the house itself. A condo has different lending rules than a single-family home, for instance. Now, let's double-click on that third C, credit. This one is a huge piece of the puzzle, so it's worth taking a second to see what actually goes into that little 3-digit number that has so much power. Now, what's so wild about this is how simple it is when you break it down. Look at this. A massive 65% of your entire FICO score comes from just 2 things: paying your bills on time and not maxing out your credit cards. That's it. If you want to improve your score, those are the 2 biggest levers you can possibly pull. And this brings us to a killer pro tip from Abdel Khawatmi. You might think, oh, I should close this old credit card I never use. Don't do it. When you close an old card, you shorten your credit history, and you can actually make your credit utilization look worse. It seems counterintuitive, but keeping those old zero-balance cards open is one of the smartest things you can do. All right, you've got the qualifying factors down. Now for the fun part, the money. Let's talk about the loan itself, and more importantly, what actually makes up that monthly payment you'll be making. Want to see how a lender thinks? It's actually pretty simple math. They'll take your gross monthly income, let's say it's 10 grand, they'll multiply it by a debt ratio, usually around 50%. Then they subtract all your other monthly debts, like a car payment. Whatever's left over, that's the absolute maximum housing payment you can afford in their eyes. And remember, that monthly payment isn't just for the loan. We call it PITI. That stands for principal, interest, taxes, and insurance. Those 4 things make up your core payment. And yeah, if you're looking at a condo or a home in a planned community, you'll probably have an HOA fee on top of all that. Now, there are a ton of different loan types out there, but these are the big 3. FHA loans are fantastic for first-time buyers or if your credit isn't perfect. Conventional is the go-to standard if you've got strong credit. And non-QM loans, these are a game changer for entrepreneurs and business owners because they let you qualify in non-traditional ways. Okay, here's another one that trips people up. Interest rate versus APR. Think of it like this. The interest rate is the sticker price of the loan, but the APR, that's the total cost. It includes all the lender fees and other charges rolled in. That's why the APR is always a tiny bit higher, and it's the number you should always use to compare loan offers. So, you did it. You're pre-approved, you're ready to shop. But in a crazy competitive market, how do you make sure your offer is the one that gets picked? Let's talk strategy. Here are 3 powerful tools. An escalation clause is basically like setting an auto bid on eBay. It says you'll automatically beat any other offer up to a certain price. Limiting inspections can make your offer look cleaner and more appealing to a seller who wants a quick deal. An appraisal gap coverage? Well, that's a big one we should define. So what in the world is an appraisal gap? Imagine you agree to buy a house for $500,000, but then the bank sends out an appraiser who says, this house is only worth $490,000. Well, the bank is only going to lend you the $490,000. That $10,000 difference, that's the gap. And in a hot market, you, the buyer, often have to cover that with your own cash. And this is exactly why having the right team in your corner makes all the difference. Navigating tricky things like appraisal gaps, or maybe a credit score that's not quite perfect, it's just smoother with an expert. A direct lender, like Got Mortgages, has the in-house flexibility to work through challenges and find solutions where a big bank might just give you a flat-out no.
We have covered a lot of ground, from the why to the how. You now have the fundamental roadmap for buying a home. You see, the process might seem complicated from the outside, but when you break it down into these clear, manageable steps, it's absolutely something you can do. So the only real question left is, with the right guide helping you along the way, what's stopping you?